Welcome, ladies and gentlemen, to the first episode of Buy the Dip. I'm very excited today to have with me a senior market analyst from Caxton FX, Michael Brown. He's one of the sharpest guys out there. And if you're not following him on Twitter, you really need to be, because he produces exceptionally high quality work. And I will be placing his Twitter handle in the YouTube's caption video when it's uploaded. The format for how we're going to run things today, we'll start off with Mike's background, a little bit about him. Then we'll run through a couple of key market themes and questions which I think need to be answered, and Mike will share his views on that. And from there, lastly, we'll finish off with a trade idea that Mike will share with us and talk us through. So without further ado, let's begin. So Mike, first question, tell us a little bit about yourself. How did you get into the world of finance? And a bit on your background and what it is exactly you do at Caxton FX.
Yeah, of course. Thank you, Luke. Let me just assure your listeners that I didn't pay for that very kind introduction. That was all off your own volition. That had nothing to do with me. In terms of my background, financial services and financial markets is very much something that runs in the family. A lot of involvement, been surrounded by the markets from a relatively young age, relatively early age. So it was always a sector that I knew I was interested in, and a sector that I was really always looking to get into. So kind of a natural thing once I'd finished education to move into the markets, and particularly into foreign exchange. In terms of my role with Caxton, just a bit of background on the business. We are obviously an international payments and foreign exchange firm based in the City of London. So my role within the business is to primarily deal with our corporate clients, providing them with insight, information, and a little bit of strategy around risk management on their foreign exchange. So we're a deliverable foreign exchange firm, and our focus is very much on risk management and reducing the volatility that is involved with businesses that are transacting cross-border, and I try and help along with that.
Fantastic, Mike. That was a good little synopsis of what it is you do. And he's dead right, ladies and gentlemen. He did not pay me anything to give him that wonderful introduction. It was all on my own volition.
You can see I've been doing this a while. I've got the elevator pitch just perfected by now.
So, Mike, knowing what you know now, what is the one thing you wish you could have told little mini Michael Brown when you were starting out?
Well, when I read the questions for this, I found it quite amusing you're saying Mini Mike Brown, because normally you're calling me Mini Mnuchin, right, after the former Treasury Secretary in the US. So I'm glad I've got a new nickname.
A stark resemblance.
If your editor was clever, he'd put a picture of Mnuchin in here now. Yeah, in terms of advice I'd give a younger version of me, I think really just kind of general advice for any youngsters that are out there is just to, when you're speaking with or dealing with more experienced professionals in the business, ask as many questions as you can, listen as much as you can, because one thing that I certainly find, I think everyone can kind of vouch for, is that the financial services industry, financial markets can seem a little bit closed off and a little bit scary at times. But actually, once you start talking to people involved in the industry, everyone is very, very friendly. Everyone is, more than happy to give some of their time to people looking to break into the industry. So yeah, ask plenty of questions, listen to the answers, take that on board, and it's not as scary as it may seem.
I agree. That's really great advice there, Mark, because I think a lot of people feel intimidated to ask those questions. And, I think you've got to go into this industry with a very open mind, wanting to learn and be curious. And no question is a stupid question. So that's some really great advice from Mark there. So Mark, following on from that sort of advice kind of theme, what are some of the biggest tips that you could give to new traders, as well as major pitfalls to avoid?
Well, I think the first thing, excuse me, the first thing that I think everyone really could benefit from a reminder of occasionally is that the market doesn't have feelings for you. The market doesn't really care what you're doing, and actually what you're doing is pretty insignificant in the grand scheme of things. So you need to stay relatively grounded and relatively humble. The other thing that I think is always worth bearing in mind is that being flat is a position. So if you don't have a high conviction view, or if you are confused by the price action, close your book, take a step back, do a little bit of research, even go and do some gardening, go and do something else to take your mind off the financial markets, whatever it is, go and play some golf, whatever.
Yes,
And
golf,
then
not
come
gardening.
back. Well, the way I'm playing golf at the minute, I might prefer to do some gardening. Take your mind off the markets and then come back when you're fresh. I think a lot of people, especially inexperienced people, can feel a bit of pressure that, you know, every day they have to do something. You know, they've got to do 10 trades a day, or they've got to sit at their desk for 15 hours while the market's open, and they must be, you know, attentive at all times. Yes, that's important, but if you don't know what's going on, if you don't have a view on what's going on, then, you know, don't put anything on in terms of risk. And I think, you know, if you, generally speaking, if you don't know, stay out.
I agree, Mark. Okay, moving on. Now that we've got all the advice out the way. So the next question is, what in your opinion, because we've gone through so many changes with COVID, you know, it's certainly not been normal for me. I mean, I ended up here in London, sunny London from South Africa. So what in your opinion do you believe are some of the biggest changes and emerging trends we're likely to see in a post-pandemic world?
Well, I guess the biggest one, or probably the most obvious one, purely because we're both doing it, well, I assume that's your apartment, we're both doing it right now, is working from home, is remote working. And how does that adjustment take place? And I think that's a huge one, because it's not only in terms of real estate, i.e. what the hell are we going to do with all the skyscraper office blocks that have been built in the City of London, but are now going to be, you know, 2/3 full most of the time at most, but also in terms of residential real estate, because you've got a situation. So, for example, house prices in London have been pretty much stagnant over the last year. House prices outside of London have been on an absolute tear, because everyone's suddenly reevaluating their lifestyle choices, where they live. They don't have to commute. They want a garden. They want a bit of country air, etc. So you've got that big readjustment taking place. But then, of course, that's going to impact the hospitality sector, restaurants, bars, etc., that have been built around the office culture. You know, sandwich shops, that kind of thing. What are they going to look like in a post-pandemic world? And I think it's going to take quite some time for all the implications of this to be figured out and to be ironed out. You know, this is not something that on the 19th of July, the restrictions lift and everyone suddenly figures out what the kind of new normal is. It's going to take a number of years, I think, for various, you know, real estate uses to be reapportioned depending on what the world looks like, for people to settle into new routines, for businesses to adjust. But I think, you know, coupled to that, you've got the fact that, and this is particularly prescient given that we've got a labour market report coming out of the US later on today, I think the pandemic will probably have caused a lot of shifts in labour markets as well. And that's twofold. One, because those who are older and may have been made redundant during the pandemic are more likely to have taken an early retirement than got back into work. And the other one is graduates coming out of university now are going into an incredibly tough jobs market. And you look at those who graduated after 2008, 2009, their career earnings and their career opportunities are so much more limited compared to their peers that graduated, you know, a couple of years earlier. And I just wonder whether we're going to see a similar thing as we come out of COVID.
And also, Mark, yeah, very interesting points you raised there. And speaking of the real estate, I was actually watching the mayoral debate for London earlier this year, and the Lib Dem candidate actually wanted to repurpose some of that office space into residential housing, because obviously in London, I've got a rude awakening when I arrived here to see the price of property as well as the rentals. I always knew it was expensive, but I think when the money started coming out of my bank account, then it really hit home. So I thought that was quite an idea, and I think quite a good idea. And I think that might be a way to potentially help more of those get on the property ladder and lower the amount that people are having to spend of their disposable income on rent. And the other thing I wanted to touch on was this theme of automation. You know, are we going to be irrelevant, you and I, if we don't become superb coders?
Well, I certainly hope not. I mean, I struggled to join this Zoom meeting and share my screen about 10 minutes ago. So I don't know what hope I've got if we have to learn to code. But no, I think automation is obviously a big factor. But again, I think one thing that COVID has perhaps proved is that you can't really rely too much on automation, because a lot of what's happened over the last 12 to 15 months has required a huge degree of adaptability and versatility, and that kind of thing, you can't really get from a black box sat under a desk. You can only get that from a human that is involved with things. So I think it's another trend that is likely to be accelerated by the pandemic, as working from home has been. But I don't think we're going to be in a situation where, robots are doing everything within the next 5 years or whatever.
Well, I'm glad to hear that, Michael. We might actually be not working from home. We'll just be at home. Okay, next one. A big trend we've seen this year with the whole Wall Street bets and the decentralized finance theme is cryptocurrencies been getting a lot of airtime in the news. So, what are your general thoughts on cryptocurrencies? Give us some insight into Michael Brown's brain on this one.
Yeah, I mean, the first point I would make is they're not currencies. So people call them cryptocurrencies, but they're not currencies. You can't use it to, I mean, yes, if you're buying a Tesla, you can probably use it so Elon Musk can speculate on it. But yeah, I can't walk out of my house now and go and buy a coffee and pay in Bitcoin. So they're not currencies. They're also probably not commodities, which they've been likened to. So I treat crypto assets as a purely speculative asset class, a purely speculative vehicle on which bets can be placed for, they have no intrinsic value. So you're essentially, technical analysis works very, very well because there's very little else that you can use in order to trade these assets. Obviously, levels of volatility are incredibly high. And I think that is probably a two-pronged thing. One, the high levels of volatility attract significant retail interest. But I think, two, the high levels of volatility probably put off increased institutional interest, because it's too volatile for an institutional investor to actually get involved with in a significant manner. I know some are kind of dabbling in it, and some have told us that, some haven't, but probably are. But I think, in a serious manner, the volatility is too high at the moment. The other thing that I would say is that I think the regulation around crypto in the short term is probably negative, but actually in the long term it's probably a positive, because it will stabilize the asset class. But I think we could easily just be looking at kind of an end game scenario, for want of a better word, of Bitcoin, Ethereum, all the rest of them ending up being heavily regulated, and then central banks and financial regulators just leverage the technology to create their own digital currencies. So all this work that the BOE and the Fed, for instance, are doing on CBDCs, what's to say they don't just slap a load of regs on Bitcoin and all the rest of them, and then just copy the tech and brand it as their own?
Yeah, I agree with you largely on everything you said there. Do you think the underlying technology blockchain has a future in the longer term? Do you think this sort of shift to digital, I know you don't want to call it currencies, but do you think crypto has a place in the future?
I think it may do. I think it's probably still too early to say. I mean, this whole thing is in its infancy. Probably a decade max this has been around. I remember back in 2017, there was an awful lot of hype around blockchain. Everyone was adding blockchain to their company name and all the rest of it. And then that kind of died a death. So I think it is probably a little bit too early to say whether it's going to be around kind of long term. I think one of the big problems with the whole kind of space at the moment is it's almost a bit of a cult, where you have, if you even suggest that the price of one of these things may go down rather than go up, you're treated as some sort of pariah in these circles. And unless and until that changes, I mean, institutional adoption or even more wider adoption just seems kind of out of the question.
Yeah, I definitely agree with you there on the characteristics of it being like a cult, and I think that even spills over into good old Tesla shares too. It's become like a cult sort of thing to say I
Yeah.
own or I'm going to buy these two asset classes. Anyway, enough chit chat about not the currency, crypto. Um, so obviously moving more closer to what we do every day, FX land. So a major talking point at the moment is obviously inflation. And I think the key question that everyone wants an answer to, as well as myself, is, will it be transitory, as Jerome Powell and co like to tell us, or are we looking at potentially a more sticky, persistent increase in prices? What are your thoughts, Mike?
Well, personally, I tend to agree with actually what the Fed are saying and with what other central banks are saying in terms of the fact that price pressures are going to be transitory. I mean, if you look at, let's just take CPI because it's the easiest and simplest and most widely watched gauge. You look at headline CPI in the US is at 5%. Or it was in June. You take the base effects out of that, it comes down to about 3%. You take out one-off dislocations from reopening, things like used car prices ripping higher, airline tickets ripping higher, then you're down to about 2.5%, 2.4%, which actually isn't that far away from where the Fed's target is anyway. Then you've got what's going on with commodities as well. And of course, commodity prices have started to roll over a little bit of late anyway. We've seen a little bit of air come out of that reflation trade, copper, lumber beginning to roll over. So I think, yes, these price pressures are going to be transitory. I think the definition of transitory is a little bit questionable. Personally, I would use that to encompass a period from probably around March, April this year to March, April next year, as in 12 months of reopening dislocations to get out of the data. I think the key thing people are getting confused about, and I don't know whether they're getting deliberately confused about it or whether they just don't know how the data works, is that transitory inflation, what it doesn't mean is that, for example, a loaf of bread costs £1 today, for instance. The transitory inflation does not mean that for those transitory factors to fade, it doesn't mean that the price of that loaf of bread has to go back to where it was before. It just means it doesn't have to keep increasing at the same rate. So what we're saying is, 5% CPI is likely to be temporary. We don't need to see inflation fall by 5% in order for that not to be temporary. We just need to see it not increase by 5% year on year forevermore. Otherwise, that's obviously something to worry about. So prices don't need to go back to the level they were at before in order for this not to be transitory inflation. I think a lot of people are getting confused about that. But obviously the risk to that is wages. If wage growth starts to increase in a significant manner, then you are likely to see price pressures become a little bit more sticky. But given the incredibly subdued nature of wage growth that we had coming out of the GFC, I think that's probably a bit of a long shot.
Thanks, Mark. Some very interesting insights there on the inflation debate, and I actually agree with you. I think we're more likely to go back to that. It's more likely to be transitory. And as you said, I think people are getting a little bit confused. We just doesn't need to go right back down to those 2% levels. It just doesn't need to carry on being 5% year on year. Mark, I'm going to skip question 7 because I now know what your trade idea is, and I'll let you discuss those things at the end. So moving back from across the pond to our own shores here. What's your outlook for the UK's prospects? And sort of intermingling with that, this whole grace period now that's been extended in Northern Ireland, they need to work on a more permanent solution. Do the issues in Northern Ireland sort of pose a risk for Brexit wounds to be reopened and therefore a bit of a Brexit risk premium to be priced back into sterling crosses? And what do you think about the risk of Scottish independence? So you've got the UK's prospects in general, and but the UK's prospects in general. We've got the Northern Ireland issues. What are your thoughts around that going forward? And then Scottish independence rearing its ugly head again.
So as I said, a lot in there. Obviously, I am probably a little bit biased, given that English born and bred and all the rest of it, but I am pretty optimistic about the fortunes of the UK economy this year. We're coming out of COVID in a relatively strong position. The vast majority of the population have been vaccinated. I'm sure you've had your jabs, I've had mine. We are in a very good position economically, with unemployment still pretty low, kept down by the furlough scheme. The Bank of England aren't going to tighten prematurely. That's quite obvious. Fiscal policy is going to remain pretty loose for at least the next 18 months or so. And I think that corporation tax hike in 2023 is something that will probably end up getting scrapped anyway.
God, I hope so. Because
Well,
I know you and I have been quite irate over that. Do you think the labour market's going to be able to stand on its own 2 feet once that furlough rug's pulled from underneath it?
I think it will. I don't. I kind of take issue with the word rug pull because it's being phased out very gradually. It's not, being turned off overnight. And I think actually the sort of gradual phase out of furlough will help the labour market, because all the labour shortages that are going on, people are being paid to sit at home and do nothing. If you stop paying them to sit at home and do nothing, they'll suddenly think, oh, I've got to go and get a job. So actually winding down furlough will probably help the labour market. In terms of the Brexit stuff, I think there's going to be a kind of classic EU style fudge for a while. The Northern Ireland Protocol, it will just be, these exemptions will just be extended and extended and extended until they come to agree a kind of proper deal. When that happens is a little bit questionable. I think it will happen eventually, but obviously the slight sort of spanner that could be thrown into the works there is that there are elections in Northern Ireland next year. So I guess ideally you'd want that problem sorted out by then. And then in terms of Scotland, I think actually on the question of another referendum, it suits both Boris Johnson and Nicola Sturgeon to not have another referendum. The reason for that being, one, obviously Boris doesn't want to be the Prime Minister that presides over the breakup of the Union. And two, for Sturgeon, there's two reasons. One is that the Leave, the independent side, has actually fallen behind in the polls quite significantly of late. And two, if the referendum is granted and they vote to stay, for instance, or even if the referendum is granted at all, that's pretty much, what's the point of the SNP after that? So I think it kind of suits both sides to talk about it a lot, but actually not do anything. So I certainly can't see a referendum taking place not before the next general election in 2024. So I don't think that's something that Sterling needs to worry about at the moment.
Good to hear. We don't want to see the breakup of the union. I know I don't. I like the golf
course
up in St. Andrews, and don't need any barriers to playing there. Mark, speaking of what you were saying about the Northern Ireland stuff on Brexit, so it sounds like, correct me if I'm wrong here, but it sounds like what you're getting at is that they're just going to basically extend until they can come up with a more workable solution. Do you think, though, that in that period where they are extending until they come up with a more permanent solution, there could be any risks of a serious flare-up where the two sides, maybe one takes a hard-line approach and it ends up actually becoming slightly more of a spanner for FX traders, spanner in the works for FX traders?
Well, I think, I'm by no means an expert on the situation in Northern Ireland. Obviously, a very sort of volatile political situation. I think, it's always a risk that it's important to be aware of, given that it is a temporary solution, these extensions. But I think it's not something, keep it on the radar, but don't get hung up on it at the moment, because it clearly is not the most pressing risk. But I think it's definitely something to be aware of.
Okay, perfect. And I didn't actually put this in the list of questions we're going to discuss, but when you mentioned elections, it got me thinking a tiny bit about over in Europe, Germany, France. Have you got any views on who you think is going to come out on top in the German elections in September? And then, Marine Le Pen seems to be breathing down Macron's neck in France, and that's early 2022 next year. So any thoughts on those two events?
Yeah, I think the German elections, which are obviously in late September, I think that's become less of an event risk for the markets lately than it was threatening to be. That the Greens have kind of faded away a little bit in the polls, and it looks like the CDU, CSU are going to be the largest party and have the chancellorship. So obviously, although Merkel will be leaving, that should provide a degree of continuity. As for the French elections, that's a much more difficult one. I know there's been a lot made of the regional elections that have taken place recently over the last 2 weekends, and how both Macron and Le Pen have done relatively poorly in those. I think it's probably worth pointing out that both of those elections have had turnouts of about 20%, so they're not entirely representative of the views of sort of France at large. I think it is something that will come much more onto the radar next year. We're still 10 months away from when that poll is likely to take place in May next year. So I don't think it's anything that's worth worrying about too much yet. I think actually we're probably too far out to even kind of countenance predicting it, or even thinking about predicting it at the moment, because, you know, a lot can change in 10 months, as we've learnt over the last year or so. Who knows what the situation will be like then. If France recovers well from the pandemic, then that's obviously going to give Macron a little bit of a boost, but I think it's probably a bit early to be thinking about that one at the moment.
Great, Mark. Thanks for that. Threw a bit of a curveball at you there, and you dealt with it exceptionally well. So obviously now onto the most exciting part of the show. What is your favorite trade idea at the moment? And could you share your screen with us just to talk us through that trade idea that you've got for us today, Mark?
I will indeed. I mean, the most exciting part of the show is, can Mike Brown work Zoom this time after messing it up last time? So keep your fingers crossed. Hopefully
there we
that's
go.
worked.
It's working
There we
perfectly.
go. I'm getting used to
You're
it
getting
now.
used to it, Mike. Don't worry. We're not going to be made redundant over coding. You there.
After 11 odd months, I think I've finally got the hang of it. Cool. So hopefully you can see a chart on the screen of the dollar index. This is nice and simple. I was bearish on the dollar, as you and probably most listeners know, for the vast majority of the first part of the year. But obviously the Fed threw us a few curveballs at the June FOMC, striking much more of a hawkish tone than they had previously, confirming that the discussion around the tapering of asset purchases was now underway, and also much less mention of the word transitory in the press conference. So a little bit of kind of implicit recognition that upward risks to the inflation outlook are out there. So I think being long dollar is an attractive position at the moment. The reason I've got the dollar index here is just because it's probably the broadest way of expressing that view, even if it is weighted kind of 57-58% towards the euro. We've got a number of interesting levels on the chart. Obviously, we're above now this key kind of 92.40, 92.50 level, which was the high on the day of the FOMC meeting here, and also the highs that we tested earlier this week. So some nice support below, and we've also got that trend line coming in as well. In terms of upside targets, the most obvious is going to be the high that we saw beginning of April, end of March, which comes in around 93.44. But then above that, if the dollar were to continue its gains, two key levels above are the November highs that we reached around the time of the election at 94.30 near enough, and then the September 2020 highs of 94.75 are the two key levels to watch above. I think, though, if you want to drill down to it in a little bit more detail, that the way that I would play the foreign exchange market over the longer term is to kind of split G10 currencies up into three distinct buckets. The first of those would be those that are likely to see policy tightened before the Fed. So you're looking there at things like the Canadian dollar, the Kiwi dollar, and the Norwegian krona. You would obviously be looking to buy those currencies against the dollar. The second of those buckets is currencies that are likely to normalize policy after the Fed. So you're looking there, currencies such as the Aussie dollar, the euro, the Swissy, the yen, the Swedish krona. A couple of those I don't think will ever get to normalizing policy like the ECB. And then sterling, which is the only currency I haven't mentioned, you're probably looking at the BOE acting on a relatively similar time frame to the Fed, which should be relatively neutral for cable, if not perhaps a little bit of downside as the market prices a little bit more aggressive action from the Fed compared to the BOE. But I think fundamentally, at least in the short term, over the next 2 or 3 months, the foreign exchange market still has some room to go in repricing the FOMC policy outlook. And as a result of that, I think dollar upside is in store.
Where, Mark, do you mind just scrolling your screen slightly to the right, just so we can see the most recent notes? Sorry, the other way, Mark, to the left, I mean. Yeah, I think our lovely faces are actually blocking out the most recent data prices. Yeah, on my charters, I'm just worried viewers might not be able to see it. So yeah, okay, so is that the most recent candle in there, Mark?
Sorry, yes, the most recent candles here over on the right. Let me put a nice big circle around it so everyone can,
I think our face is still, I think on my screen, our little tiles are still blocking that. So I think we need to scroll even further to the left, Mark.
I think it might be your screen because you're on the other side on mine, but
okay, perfect, right.
There we go.
So Mark, where for you would be a place where you potentially would like exit the trade and maybe put a stop loss that goes against the bullish sort of view on the dollar? Where would it start to change your mind?
I mean, it depends on your kind of time frame that you're looking at. I think over a longer horizon that I've just outlined, you've really got to get back below that 200-day moving average for me to start thinking about the dollar bull run being over. If you're looking at things on more of a short-term basis, then obviously you've got this ascending trend line that I've just put in this morning. You've also got that 92.40 level if you want to go super short term. That's worth bearing in mind. But the kind of longer run outlook that I was giving there and that I tend to give our clients, unless we break below that 200-day at 91.5, then I'm pretty confident in that viewpoint holding firm.
And Mark, tell us a little bit. So I completely agree with what you're saying about breaking the FX baskets into segments: Norwegian krone, Kiwi dollar, and the Canadian dollar being the more hawkish central banks. And then you've got obviously the funding currencies like JPY and Euro, who have had historically weak inflation, which will obviously anchor their monetary policy firmly at where it is now. And as you say, policy normalization is going to take ages if it ever happens for those currencies. So completely agree with you there. Mark, I just wanted you to run us through sort of your process in terms of how you look for trade ideas, what information comes into your decision-making process, and why you use the specific indicators that you do use.
Yeah, of course. I mean, as you can probably see from the chart, I like to keep things relatively simple. You see some charts out there with so many indicators on that you can't even see what's actually happening to the price. So I don't like to clutter things up too much. In terms of how I would sort of go around finding an idea, I tend to look at the fundamental side of things first, and as I've just explained, really kind of divide things up. Depending on, in this example, the monetary policy outlook, but earlier in the year or even last year, we would be looking at things like the progress with the pandemic. Whatever the kind of primary market driver is at the time, you would look to divide the market up based on how the currencies, how the economies are performing against whatever that variable is. And then you would obviously use that to determine what you think is likely to appreciate, what you think is likely to depreciate. And then very simply, Once you've got that fundamental view, have a quick look at the charts, see whether that likely reinforces what you're looking at. Obviously, you can quite easily fall victim to confirmation bias when you're using technical analysis. So obviously, you need to be aware of that. But in this case, obviously, the fundamentals align with the relatively bullish technicals as well. And the other thing that helps with this trade, if I just flick over to this chart here, and actually this is positioning. So you've got the fundamental bull case for the dollar, which is a repricing of the monetary policy expectations. You've got the technical bull case because we're above the 200-day, we're above the resistance at 92.40, etc. And then the positioning was heavily short dollars going into the FOMC meeting. That's now started to unwind. And as we move through the summer, one would expect that to unwind further. So you kind of got those three factors all aligning, which then makes that much more of an attractive position than just, for instance, we've crossed over a line, that means we must buy it.
Yeah, the stars looks like they're really starting to align for the dollar, both technically positioning data-wise as well as fundamentally, and with especially now with the policy normalization fuse having been lit by the Fed. I don't think it's going to be.
Now I've said all that. That will probably mark the top for the dollar.
Thoughts on EURGBP?
My main thought on euro sterling is, can it please do something quickly, because I'm getting bored watching
Trapped
it.
in that
It's
range,
going
yeah.
absolutely nowhere. I'll just bring it up quickly.
Yeah, actually bring it up. Yeah, that'd be great.
There is just absolutely nothing happening. We have just been going nowhere for, really since May. The cross has just gone nowhere. Why has it gone nowhere? Because both the UK and the Eurozone economies are opening up at relatively similar speeds. Both are kind of jabbing at relatively similar speeds. And there really isn't a lot of divergence to play. Over the longer run, I think you'd probably be looking for euro sterling to move lower, because the Bank of England are going to act before the ECB. I think that's, really, there's really no question around that. But actually, euro sterling has tended to do this over the years, where we have a big move. So obviously we had this big move earlier in the year, where you've got this was essentially vaccine driven. The UK is vaccinating faster than the EU. We're going to reopen quicker, and a bit of Brexit in there.
Brexit risk premium was unwound. Yeah,
5 big figures or whatever it was. And then we go sideways for a while. And actually, if you look back, euro sterling tends to do this. It will trend for 3-4 months, and then it will go nowhere for 6, and then it will start trending again. So I think it's just a question of what that catalyst is. It will probably be a more hawkish shift from the BOE. The question is when that comes, and that might not even come until the end of the year.
Yeah, completely agree with you. We've been stagnant on EURGBP as a result of those vaccine differentials and the Brexit risk premium being unwound now. And now the only differential and catalyst that I can see that would actually cause further EURGBP weakness would be the differential in the central bank's normalizing policy. Where would you reckon, because I mean, it's, as you said, almost 5 big figures there. Where do you reckon is fair value for this cross? I mean, how much lower could we be looking at here, Mark?
Well, I think if we just zoom out a little bit, I mean, that's going back, 18, maybe 24 months. This is kind of the post-Brexit low. Actually, let me go out a bit further.
Yeah, let's go pre-Brexit and see where EURGBP.
What we've done is really, since the referendum, which is right on the edge of the chart here on the left-hand side, since the referendum, the cross has pretty broadly been stuck in a range between about those two bands. So,
okay, so 0.83 round number,
83 to 93, essentially. We've been in, a 10 big figure range since the referendum. And to be quite honest, I don't really see what's going to break this range. So I think, 83 is the long-term level to be looking at. Whether we get any lower than that, I think is a little bit questionable in the near term.
Do you want to just go back to the pre-referendum price action there? If you just, perfect, Mark.
Yeah, let me zoom out of it. There we go.
So we see back in 2015, it got almost down to 0.7. I'm looking there, I think. So yeah, what do you think would have to happen to get us back there? I mean, obviously, technically, we'd have to break through the 0.83 range support, but
Yeah.
fundamentally, what do you think could get us back down there?
Well, you're going to have a huge rate differential between the UK and the EU to get back to that kind of level, which in a world of, super low interest rates just doesn't seem at all likely to happen, to be honest. So
Mm.
I think that, this kind of 10 big figure band, that is incredibly well established. And, it's going to take a lot to break out of it.
Mark, we've had a very interesting chat today. I don't want to take up any more of your time on a Friday. I've really enjoyed this.
No, thank you very much
And
for having me on.
I'm sure the viewers have found it incredibly interesting and very insightful. And I think what's nice is, especially on EURGBP, you're actually showing how an experienced analyst like yourself looks at the charts, what is incorporated into your process, and from a fundamental, technical, and positioning standpoint. And yeah, I've really found it valuable, and I'm sure the viewers will too. So thanks, Mark Brown, for joining us today. It's been an absolute pleasure. You dealt with the curveballs I threw you exceptionally well. And I hope you've got a tee-off time scheduled for this weekend.
I do indeed, but let's get the jobs report out of the way first.